Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 14th, 2026, and it's Valentine's Day. So happy Valentine's Day to you, and I hope you're going to have a really nice weekend. I hope you had a good trading week last week. Boy, it was really volatile, really interesting, volatile week. So I hope you hung in there. I hope you stayed safe, and obviously, I hope you made a little money. If not, we have next week, and we'll see if we can take a look at some good potential trades for next week. So the forecast for the weather, the format today for the podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the positions that I have, the new positions that I got into, and the positions that I got out of. So basically, we're going to talk about when I entered, why I entered, what the signals were, what the confluence of signals were, and why I entered, how I position size based upon the volatility of the market and my account balance, how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the market that I'm trading moves in my favor, what I do when I get to trailing stop level, and then ultimately how I am going to exit the trade. So yeah, last week was an interesting week. I had some really good trades. I had some trades that I got stopped out of, but yeah, it was really, really volatile. So, the market can turn on a dime. So the most important thing that I want to convey here today is that we need to have a plan so that we know what to do regardless of what the market does, because it can do anything at any time. You don't want to be caught flat-footed, and so you without a plan to know what you are going to do. So after we talk about the trades, we are going to spend a little bit of time on trader psychology. Always the most important skill in trading is the ability to create a plan and follow it. I've been trading for over 30 years. Really, in the long run, the best way to make money is to have a process, is to have a plan and then follow it. But it's not as easy as it sounds, because the market changes, we're making money, we're losing money. It tends to elevate our emotions and to make emotional decisions. And usually with that, what happens is that, if it goes down, even if it hasn't hit your stop, you feel like, oh, this is going down for sure, and you want to get out early. Well, then maybe it turns back around. Or a lot of times what people don't talk about is when it starts going your direction, they don't have the patience to sit in there and try to get the full value out of the trade. They see it move up and they just take it for no particular reason. So there's two challenges: getting out of your positions quickly if you're wrong, and staying in your positions when you're right. And so anyway, we're all human. We're all susceptible to these kind of things. But ultimately, your trading life is going to be easier, in my opinion, you're going to make a lot more money if you just have a plan, a process, and you stick with it. And that comes down to trading psychology. So we'll spend a few minutes on trading psychology. After that, I did go down through my watch list, my natural master watch list last night, and I do this every Friday night. I go down through it and I go each mark one by one in each market, and I look for potential trades for the upcoming week. And what I'm looking for specifically is I'm looking for key levels of support. If I want to go long, I'm looking for key levels of support and multiple levels of support, which can include order blocks, major moving averages, RSI levels, MACD divergences, V1s, V2s, and ideally all of these together. Because if you're patient and you wait for a confluence of signals, it doesn't guarantee that you're going to have a profitable trade, obviously, but it does increase your odds. It increases your chances. And as a trader, really, that's all we can do. We're looking for confluences of buyers coming together, because essentially, if you have more buyers from different signals, if you have signal A, you have buyers, you have signal B, you have buyers, you have signal 3, you have buyers. When they all come in together, obviously you have more, and the more buyers you have, the better chance you are going to have a profitable trade. So I'm going to show you what I'm looking for. These markets are not where they need to be yet. They may never get there, but they're within striking distance enough for me to highlight those on the podcast today. And if they do get there next week and they offer me a good risk to reward ratio, I will consider taking the trade. So I'll share those with you at the end of the podcast. All right, so let's run the U.S. legal disclaimer, get that out of the way, and then when we come back, we'll go through the current open position. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me. And so let's get started. We're going to go through the current positions that I have that are open to begin with. So let's start with VIX. I've been in the VIX trade for a few weeks. It's been a really good trade. And I did enter VIX here on the 15th of January at 26.29. So this strategy right here, whenever you see a green box, this is an order block that I have placed myself based upon the following structure. And so for an order block to appear and to define as an order block, we need this to happen. We first need to look for a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. So this is a swing low here. Following that, we need a swing high. A swing high is just the opposite. We have a lower high to the left and a lower high to the right. So you can see we have a swing low, we have a swing high. Then the next thing we need to look for is another swing low that's lower than the first swing low. And you can see this low, this is a swing low because we have a higher low to the left and a higher low to the right. So we have a swing low, we have a swing high, we have another swing low that's lower than the first swing low. That's the key. Now, when this is in place, as soon as I have a swing low, swing high, lower swing low, we need to key off of that first swing high. And if in the future the market goes above that first swing high, now we have changed market structure to the upside. And as soon as we change market structure to the upside, I can define the order block. And so here, so we have a swing low, we have a swing high, we have a lower swing low. Here, we take out that swing high. As soon as this happens, now I know that the high and the low of the lowest closing bar before market structure change is my order block. And so I have highlighted the high and the low of this bar, bringing it into the future. So when we change market structure to the upside, I'm not looking to buy the breakout. I am looking for a pullback after the market structure has changed. Okay, so it changed here, and then it took off here. I wasn't in the trade yet, but now I'm looking for a pullback back into this order block someplace in the order block. And a lot of times with order blocks, I like when they have a major moving average inside of the order block, maybe an under 30, over 30 RSI in the order block, or there are times when I will place my own particular level. And on this trade, I did that exact thing. And if we look at the bar here, this bar here on the 13th, we had a very big, strong up bar. If I have a big up, a strong up bar, I know from Fibonacci that at the 50% mark, the halfway of the big up bar, if it comes back to that halfway, it's generally going to find support there. So that is why I drew this line, this solid green line inside the order block. So swing low, swing high, lower swing low, market structure change. Again, I didn't buy this, but now I'm looking for a pullback into the order block, the green block, and I placed the halfway, this 2610 level, because it was a big up bar halfway. So then it came back down, and on the day that I entered the trade, I entered the position long because it rejected. You can see during the day we went below it and then we closed back above it. So that became my entry. Now, as soon as I enter the trade, well, let's talk about position sizing first, excuse me. So that's the reason I took the trade, right? We have an order block, we have a pullback, we rejected that key level of 2610, and I said, okay, I'm going to buy that. So the first thing I have to decide is how many shares am I going to buy? Now, it's a really easy formula. I've been using it for decades, and it takes a lot of things. It's very simple, but it takes a lot of things into consideration. And I need two inputs. The first input I need is how much do I have in my trading account? Let's just say I have a $100,000 trading account. It's very simple. 1% of whatever my trading account. If it's 100,000, it's 1,000. If it's $200,000 trading account, it's 2,000. If it's a million, it's 10,000, right? So the very first thing, 1% of my total trading account, let's say I have $100,000, 1% is $1,000. Now, the next thing I need to look for is what is the average true range, the two average true range. This is average true range times 2. And right now it is $3.06. So all I do is take that maximum allowed loss, which is 1% of my account, whatever that is, say it's $1,000, divided by 306. That's telling me to buy 326.79 shares. So I will just round that up to 327 shares. And the reason why it's important for me to use the 2 ATR is that when volatility is greater, this number is going to be larger. And when I divide a larger number into my maximum allowed loss, I'm going to get fewer shares. And that's the correct way. That's correct trading. Reducing your position size when volatility is higher. If volatility is lower, this number is going to be lower, and therefore my number of shares I'm going to buy are going to be higher. That's the correct way. A lot of traders do not adjust their position size based upon the volatility of the market. And by using this formula, it does it for me. It makes it very easy. So here we go. I buy 327 shares here. Why? Again, swing low, swing high, lower swing low, market structure change, defines the order block. I also put a key level inside of the order block, which is halfway of the big up bar, and I enter at 26.29. Now, the first thing I need to do after I enter is I need to place my emergency stop. And my emergency stop is exactly whatever the 2 ATR was minus my entry price, because we did the math, right? 1,000 divided by 306. So I enter here 26.29 and I minus 306 from my entry price, and that is my emergency stop. Now, if I enter the trade and it goes down to my emergency stop, how much have I lost? I've lost 1% because we did the math, right? 1% of my total trading account divided by 306. So if it does come down to that emergency stop, I will have lost 1%. But the good news is that only happens about 5% of the time. The other 95% of the time, if you have a loss, it will be because of your end of bar stop. And your end of bar stop is always going to be closer than your emergency stop. So the end of bar stop here, I had a little change on my trading plan in the middle here, and I'll explain why. But really, my end of bar stop was a close below this 2610 level, which was the big up bar, halfway the big up bar. So I have a very tight stop. You can see 26.29 was my entry, 26.10 was my stop. So it was a theoretical 9-set stop. Okay, but I changed a little bit, and I'll explain why. But so enter with the rejection of the halfway of that bar, 26.10. Position size, place my emergency stop below. My end of bar stop closed below the low of that midpoint. Now, the next thing I do as soon as I enter the trade and I know where my emergency stop is and I know where my end of bar stop is that I look for my trailing stop level, my trailing stop threshold. And now I need to look for the 1.5 ATR, and the 1.5 ATR right now is $2.30. So after I enter the trade, I know where my emergency stop is, I know where my end of bar stop is, I take my entry price plus 1.5 and I place it above my entry. And this is the orange line. Now, the significance of this is that if after I enter the trade, it gets to my trailing stop level or higher, all that means now is that I am in trailing stop mode. Just because it gets to the orange line doesn't mean I do anything. It just means that now that I have reached that orange line in the future, if I have a close below the previous bar's low, I'm going to get out of half of the trade. All right. And so everything I've talked about so far, as far as the rules, have been the emergency stop, the end of bar stop, and going into trailing stop mode. These are all considered defensive moves. Or in other words, if the market goes against me somehow, I need to take some action. But I also like to play offense in my trading as well. And the way that I play offense is that I take partial profits off into strength when the market goes into my direction, if I have them. Not everything, just a partial amount. And I'll show you exactly what I do. It's very easy. So, and I'll show you where I'm placing this, the profit targets for Monday. All I do is I take the closing price. Right now, the VIX is 29.25. So I take the closing price of the day, and I have to do this every day, right? I have to readjust it every day for the next day. But right now the price is 29.25. Now I locate the 0.45 value. Right now the 0.45 value is 69 cents. So I take so for Monday, or for Tuesday, because the market's closed on Monday, for Tuesday, closing price plus the value of the 0.45 ATR, which is 69 cents, but this changes every day, and I add them together, plus 0.69. My first profit target for Tuesday is 29.94. So let's just put it up here so I can show you. 29.94 is my first profit target. Now I'm going to place another profit target. My first profit target is 29.94, right? Closing price plus the value of the 0.45 ATR, which is 69 cents, 24 or 29.94. Now I always place 3. So I take my first profit target, 29.94, and I again add the 69 cents to it. My second profit target for Tuesday is 30.63. So now I have 2 profit targets. And to get my third profit target, I just take my second profit target, 30.63, and I again add the value of the 0.45 ATR, which is 69 cents, plus 69 cents. My third profit target, 31.32. So the question is, all right, Greg, you've shown us where I'm going to place my profit targets, but what do I take off there? It's very simple. I take 10% off of however many shares I went into the day with. If I go into Tuesday, let's say I have 500 shares right now, I would take 50 at the first, 50 at the second, 50 at the third, right? If I have 1,000 shares, it's going to be 100, 100, 100. So, and I do this every day, and every day my the amount of shares that I have, or not every day, but a lot of times if I hit profit targets, it's going to reduce the amount of shares that I have. So therefore, I'll be selling less and less and less, and that's by design. So again, for Monday, this is how I place my profit targets: closing price plus the value of the 0.45. That gives me my first. I add the 0.45 to it again. That gives me my second. I take the second, add 0.45 to it again. That gives me my third, and I go into the day and I sell 10% at each profit target. Now, if Monday or Tuesday VIX goes down, I'm not going to hit any profit targets. I'm going to have to recalculate for the very next day. But if I have a decent up day, okay, I'll hit 1 profit target. Maybe I'll hit 2 profit targets. If it's a really good day, if it's a great day, I'm going to hit 3 profit targets. But I like selling into the strength. There's a lot of advantages. And one of, 2 advantages right off the top of my head. One, you are scaling out into strength. You're taking advantage of strength. That reduces your position size, and the lower your position size becomes, the more likely you are to continue to follow your process. It's just how it is. The other advantage is every single time I hit a profit target, I'm essentially moving my stop up. It's just like trailing stop level. If I get into trailing stop level, and then I have a close below a previous bar's low, that has the effect of moving up all my stops by half. That's trailing stop. But taking the partial profits also moves your profits up. Every single time you take something off, it moves everything up. And that's correct trading. All right. So, okay. So that's the offensive and the defensive part of the trade. So let's go through the trade. So again, I entered here on the 15th at 26.29. Why? Because we had a swing low, swing high, lower swing low, market structure change, pullback, rejection of that midpoint of 26.10. I entered. The very next day, it goes up a little. I think I hit 1 profit target on that particular day. Okay, great. I took a little off at profitable levels. The next day, we had that skyrocketing update. I mean, I hit so many profit targets here, everybody. I think I hit 8 profit targets. I think it was a record. So what does that mean? That means that really on this particular day, I only set 3 profit targets, but it kept going, so I had to manually put those in. So I essentially got rid of 80% of my position on this day up, which is crazy, but it happened, right? So the next day, I hit all these profit targets, and then clearly I got to trailing stop level, which means, again, if I have a close below a previous bar's low, I'm going to get out of half. What happened the very next day? We had a close below a previous bar's low after reaching trailing stop level. What did I do? I took off half of the remaining shares that I have, which was not a lot because I sold into that strength. So, but the remaining shares that I took half off of was a gain of 1.76%. Now, this is where I kind of called an audible in the trade because I had so few shares left. I just wanted to ride this out essentially for the podcast, just to show you about the process. So the next day here, we closed below my end of our stop of 26.10, but I didn't get out of the trade because I had so few shares left. I was like, okay, I can withstand that. And it's good for the podcast. If it continues to go off, I can continue to show more trades. So yes, technically, really, I should have gotten out here, but I didn't. I stayed in the trade. I was using a close below the low of the order block. The next day it went up. Next day, nothing. Next day, up a little. Next day, up a little. Next day, up again. I did sell some profits, or I did have some profit targets into that big strength. Then we came back down. Notice here, we came back down on the 2nd. Notice where we stopped exactly at that 26.10 level. Then we had another huge up bar where I continued to take profits, another up bar where I continued to take profits, another big up bar where I continued to take profits. Then we moved down for a couple days, right to the top of the order block. And then Thursday, we had a big up bar where we hit another profit target. And then Friday at the top, hit another profit target as well. So the remaining shares which I have, which are not a lot, are doing really well, right? They are up 10.12%. But I've mentioned over the last 3 weeks with this order block, I said, listen, if VIX comes back to that order block, we need to be careful in the market because very likely if VIX comes back to the order block, that means the market went down. That also means that VIX is very likely to bounce. And if VIX bounces, the market will go down. And you can see that is exactly what happened. So I like to use VIX as an indicator as potentially getting some ideas of where the market's going to go. I mean, we're kind of elevated here on VIX, so I wouldn't be surprised to have some kind of bounce in the market. But we'll see. We'll see. But again, this was just a order block that I placed a level in. I waited for market structure to change and then waited for a pullback, and that was it. So the remaining shares that I have on VIX up 10.12%. PLTR. Okay, we have green box there. This is another order block. I entered PLTR on the 5th of February at 129.62. Let's go back in time and find out where this order block originated from. And it originated a long time ago. It originated back in July. These order blocks tend to have memories, and I can use order blocks from months and months and months ago. They have this memory. So again, let's talk about why this order block originated back in July. Well, first of all, we need a swing low. Here's the swing low. Then we need a swing high. Here's the swing high. Then we have another swing low here, right? Here's a low with a higher low to the left, a higher low to the right. This swing low was lower than the first swing low, so swing low, swing high, lower swing low. Now remember, the key level to change structure is that first swing high. This is the green bar. So in the future, if we go above it, which happened here on the 14th of July, this change market structure to the upside. Now, I'm not buying the breakout. I'm waiting for a pullback to the order block after the breakout. And the way that I like to explain this is, they're called order blocks. I didn't develop them, but I look at them a little bit differently. I look at them as smart money areas because, okay, on this particular day, when we change market structure to the upside, look what happened. We went way, way, way up. So when the price is way up here at 189, and I look back here where the order block 134, where this was formed, is it safe to say that when the market's up here and I look back here that smart money was buying here? Yeah, of course. Of course. I mean, it's clear, right? Hindsight's 2020, but when you're up here and the order block was formed down here, you go, yeah, that order block was smart money. So I want to bring the smart money area into the future so that if and when if it eventually gets back down here, it's getting back to the smart money area again. Now, does it mean that if it was once smart money, that it has to be smart money in the future? No, definitely not. Things can change. But in my experience in 30 years of trading, more often than not, when it gets back to the original smart money area again, more times than not, it is smart money again. So again, I bring this, we have the order block here, swing low, swing high, lower swing low, market structure change defines the order block, bring it into the future, and all the way from July to February, finally, we got back to that level. And so I entered PLTR here on the 5th of February at 129.62. Why? So with order blocks, there's many different ways you can use them for entries. A rejection of the high of the order block, that is one possibility. A rejection of the low of the order block is another possibility. A rejection of a major moving average inside the order block, that's another possibility. A rejection of a 30 RSI inside the order block, another possibility. Just like I showed you on VIX, I drew my own level inside the order block. That's another possibility. So really what my favorite trade, everyone, is a key level within a key level. So a valid signal within a key level. So here we have a rejection of the low of the order block, right? We went below the order block during the day, and then we close back in the order block at the end of the day. So I entered here 129.62. I position size based upon volatility as I showed you. I placed my emergency stop 2 ATRs below. That defines my maximum 1% risk on the trade. My end of bar stop is simply a close below the order block. Look, I'm very close to the order block already. So if the next day it had closed below, even by a penny, I would have gotten out for a loss, but a very small loss if it barely closed below, right? I have my 1% maximum loss here. Anywhere from here to here is going to be less than 1%, but it was very close to my end of bar stop. And again, if it closed below 1 penny, 5 cents, 20 cents, I'm simply out of the trade. Okay, so I got in because of rejection of the bottom of the order block. I got in 129.62. I placed my emergency 1% stop, 2 ATRs below. I then take my entry price, add 1.5 ATRs above for my trailing stop level, and let's take the trade. What happens? Next day, it gapped up. I hit a profit target, but it hasn't got to trailing stop level. So all that I did was took a profit target. The next day, it went up again nicely. I hit multiple profit targets this day on the way up. Great. I'm reducing position size. I'm taking advantage of the strength. On this particular day, also, we got to trailing stop level. Again, it doesn't mean I do anything. It just means that now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Next day, nothing burger, was down a little bit, didn't go up enough for me to hit a profit target, but didn't close below previous bar's low, didn't do anything. The next day, we have our first close below the previous bar's low. After reaching trailing stop level, what am I supposed to do? Take off half of the remaining shares that I have. And I did that for a gain of 4.61%. The next day, down, but saved by the bell. Again, it went under the bottom of the order block. Had it closed down here, I would have had to get out of the trade, but it stayed back. It closed back in the order block, which again kept me in the trade. Friday, we opened below the order block. We played around down here a little bit, but by the end of the day, saved by the bell again, kept me in the trade. All right, so the remaining shares that I have on PLTR up 1.29%. But again, am I glad that I took partial profits here and partial profits here much higher? Yeah, of course. Of course. If it closes below the order block on Tuesday and I have to get out, okay, fine. But at least I played some offense and took some profits into that. And then I took off half of everything right here, right? First close below previous bar's low after each trailing stop level. So I have rules. If it continues up, I'll take partial profits, right? If it closes below the low of the order block, I'll get out of the trade. If we get to the 65 RSI level, then I have other rules that come into place. If I reject the 70 RSI level, I have other rules that come into place, which I'll show you in a minute on some of the previous trades. But this PLTR trade, yeah, it's been rough, but profitable nonetheless. The remaining shares up 1.29%. ARK. All right. So we have an order block from the past, smart money area from the past. I entered ARK here on Thursday at 68.41. Why? Rejection of the bottom of the order block. Okay, so I position size correctly. I have a very good risk to reward ratio in the future. If it closes even 1 penny below, I'm out, but I position size. I place my emergency stop below. I place my 1.5 ATR trailing stop level above. Now, most of the time, I'm going to take a trade that has some kind of confluence, meaning I have not just one signal, but two. And really, there were two signals here. But let me explain to you why. It comes back to these three bars. These three bars are called the V2. I use V1s and V2s for many different reasons to help enter a trade or for support levels. This one is a V2. And by the way, if you want to learn more about V1s, V2s, go to my YouTube channel. I have a video on V1s, V2s. Watch it. It explains it in detail. But a V2 consists of three bars. Bar 1, bar 2, bar 3. The rules is that bar 2 has to go below bar 1's low. Does that happen? It does. Bar 2 goes below bar 1's low. Bar 3 then has to close above bar 1's close. Did that happen? It did. Bar 1, 2, and 3. 2 goes below bar 1's low. 3 closes above bar 1's close. This is called a V2. The support level on a V2 is halfway of the washout bar. The The number 2 bar is the washout bar because it washes out or goes below bar 1's low. Okay, so I know there is some kind, when you have a V2, that halfway of the washout bar is going to be a uh, some type of inherent support. Well, on the day that I bought this trade, look at the bottom. Look where we came to on that day. We got almost exactly to that support level, and that's where it held. Pretty cool, right? Doesn't always happen, but happens more times than you think. So that is what got me into the trade. I saw that it rejected the halfway of the V2 bar, and it also rejected the bottom of the order block. So that is why I took the trade again. Okay, so again, position size, emergency stop, 2 ATRs below, end of bar stop, close below the low of the order block. It's very close to that already. Place my 1.5 ATR trailing stop level above. And then on yesterday, on Friday, I was able to hit some profit targets on this, on this move up. You can see we're not in trailing stop level yet. But if we do, then I'll go into trailing stop mode. But just barely got into this trade. And so what happened to my entry? It's here. There we go. But so far, this particular trade, it's a new trade, only one day, but so far this trade's doing pretty well, up 2.65%. Nike. All right. You know, I show you a lot of order blocks, but one of my favorite entries is called a higher low V1 or V2. And this is what happened on Friday. And thank you to my student Vivek, by the way. He pointed this out to me. I was looking at some other things, but he pointed it out to me. And I went, oh yeah, that is better than anything I'm looking at. So Vivek, thank you, bud. I appreciate it. So I did enter Nike on Friday here at 62.90. So why? Well, a higher low V2, the rules are, let's first take a look at this top green line and this bottom green line. Anywhere between anywhere between the low of the upper green bar or the line or above the bottom green line, anywhere in the order block, anywhere in the value zone here, or anywhere between these lines is considered the value zone. And so the rules for a higher low V1, V2 is, first of all, you have to close below the value zone. Well, clearly all these bars close below the value zone or close below the green line. The next requirement is that you need to then rally back up into the value zone. Well, it did. The next requirement is that you need to pull back and then create a V1 or a V2. Well, I just showed you on, what was it? Yeah, on the ARK about the V2. Well, this is a V2, 3 bars, bar 1, bar 2, bar 3. 2 goes below bar 1's low, 3 closes above bar 1's close. So this is a legitimate V2. So we need it's called a higher low V1 or V2 because this low here that was made on the V2 is higher than this original low. So let's put it back all together. We have a close below the value zone, we rally into the value zone, we have a pullback, and then we have a V1 or a V2, and that V1 or V2 has to close in the value zone like this did. And again, the bottom of this V2, this low is higher than this low. Higher lows are much better place to enter a trade than lower lows. Okay, so I entered here at 62.90 because of the higher low V2. I also entered because this bar is green, the previous bar was red. I've mentioned this a little bit in the last few weeks. This is called the Elder Impulse System. You can get this on most charting platforms. Just look for Elder Impulse System. But you can see all my bars are either red, green, or blue. Red means momentum of the MACD is down and we're into a downtrend. A green bar means that MACD momentum is not increasing, it's decreasing, and trend has changed up. Blue means that you either have an uptrend with down momentum or you have a downtrend with up momentum. So essentially, red bars are green, red bars are bearish, green bars are bullish, and blue bars are indecisive. Okay. But what I have noticed, when you have a rapid change from red to green, what does that mean? That means that very quickly, this essentially means on Thursday, momentum was down, price trend was down, but we had an immediate change from being both bearish signals to both bullish signals in one day. And most of the time you go red to blue to green, but when you go red to green, it's a sudden shift in sentiment. And in my experience, that is a good thing and shows that it's bullish. Now, I wouldn't take the trade just because the red green, but this is a completely legitimate higher low V2. And the added kicker on top is that we went red green. Okay, so let's see. Oh, I didn't place my trailing stop level, so let's do that. So I take my entry plus 263, which is 1.5, right about there, a little bit below it. Okay, so that's going to be my trailing stop level. Okay. So higher low V2 entered at 62.90. I position size, I placed my emergency stop 2 ATRs below, as always. My end of bar stop, again, because this is a V2, is halfway of the washout bar. The washout bar is the number 2 bar. Halfway, right there, 61.70 is the key support level. Tuesday, if we close below that halfway, I'm simply out of the trade. That's it. So it's giving me a little bit of breathing room here on the trade, but the key level is 61.70. So that's my end of bar stop. In the future, if it closes below 61.70, I'm simply out. I place my trailing stop level above, and now I know exactly what I'm going to do. If it heads up, I'm going to take partial profits. If it gets trailing stop level, I'm going to go into trailing stop mode. If it goes down on Tuesday but closes above halfway, I'm going to stay in the trade. If it crashes down and hits my emergency stop, what I'm going to do, I'm out and I'm going to lose 1% of my position. So I just entered this. It's up slightly, but this will be kind of good to show you going forward how it worked out. As a matter of fact, I had the exact same trade on Apple. I exited Apple last week, but I have the exact same trade. It was a really nice trade, but it was this exact setup as well. So Nike remaining shares, or the initial shares that I bought on Friday, up 0.35%. Okay, so those are our open trades right now: VIX, PLTR, ARK, and Nike. So they're all fine. They're all profitable so far, but I did have some trades that I had to get out of last week for multiple reasons. I hit my stops, there was earnings, or other rules that got me out of the trade. Let's start with Netflix. Okay, I entered Netflix here. It's like the third or fourth time I've entered Netflix. I've tried and tried to get a bounce on this, but I have not been able to. But I've taken my stops, which luckily you'll see why it was important that I did. But I did enter Netflix on the 9th of February at 81.60. Why? We had a rejection of an intraday rejection of a 30 RSI on this day. In addition to that, we had some bullish MACD divergences. And that is the confluence of why I took the trade. So I did enter here 81.60. I placed my emergency stop 2 ATRs below. I placed my 1.5 trailing stop level above. The next day started off. I was like, oh, great. I hit a profit target. Fantastic. But then the next day it closed below the 30 RSI. Let's look. Let me show you the day that I entered. Okay, the day that I entered, it closed at 31.53. Okay, it went under 30 during the day, but then closed above 31.53. Okay, that's why I entered. My stop is if it closes below the 30 RSI. The next day, as I showed you, it went up. We hit a profit target. It still stayed above 30 RSI, but the next day, where did it close? 29.31. That's my stop. It closed back under the 30 RSI. So I got out. I took a loss of 2.55% on the trade, but thankfully, look what happened the next day. Down again. So it's not fun to take a loss for sure, but honestly, if you take a loss and the next day it goes down, you're like, oh, sweet. Okay, good thing I took that loss, right? So yes, but I took this with an intraday rejection of the 30 RSI. On Wednesday, it closed below the 30 RSI. That was my stop. Got out for a 2.55% loss. Berkshire Hathaway. Been a really nice trade that I exited. I got into the trade here on the 29th of January at 475.68. Why? Rejection of the bottom of the order block, rejection of the long-term megaphone trend line. It went under 30 the previous day, closed above 30, okay? Another signal. We had a V2 and we rejected the negative third ATR channel. So I had a lot of primary and secondary signals, a lot, I think 5. Let's see, rejection of the order block, rejection of the bottom of the rejection of the bottom of the order block, rejection of the trend line, rejection of the 30 RSI, 3 primary signals, and then I had 2 secondary signals. The 2 secondary signals were a V2, bar 1, 2, and 3. 2 goes under bar 1's low, 3 closes above bar 1's close, and rejection of the negative third ATR channel. So, it doesn't really get better than this particular setup, and it did work great. So I entered here, 475.68. I placed my my emergency stop 2 ATRs below. My end bar stop was simply a close below the order block. I placed my 1.5 ATR trailing stop level above. And here we go. Next day, went in my direction, took off some profit targets. Next day, up again, took profit targets into that strength, also got to trailing stop level. I don't do anything. It's just that now in the future, if I have a close below previous bar's low, I'm getting out of half. Next day, races up again, massive move up, selling into that strength. Next day, up again, massive move up, selling into that strength. Now, at this point, we were above the 65 RSI level. And if I ever get to the 65 RSI level, now this 5 EMA, this is this thin blue line here, comes into play. So whenever I get to a 65 RSI level or higher, and then I have a close below the 5 EMA, that's the end of the trade, and that is why I exited BRKB. So this was a fantastic trade. My signal told me to get out when I had a close below the 5 EMA, and so this trade locked it in last week for a gain of 4.5%. But starting with the really good confluence of signals with a really good risk to reward ratio, and I was fortunate on this trade that it just rocketed up. And so again, gain of 4.5%. TMUS, another good trade I took here on the 28th of January. I entered at $186.20. Why? Well, we had this megaphone trend line. Megaphone trend line is I really incorporate these into my trading a lot, but a megaphone trend line is when you have a swing low and then you have another swing low and you connect the swing lows, and then that trend line continues off into space. And if you make the connection of that third point, this is the first point, this is the second point, the third point here went under it, close back over it, but very often when you close back over it, you'll get a retest of the trend line, which exactly we closed over it, then we closed back under it, and then we closed over it again. That was my signal, was a rejection of that megaphone trend line. In addition to that, the confluence of the trade was we had what is called an abandoned baby. And an abandoned baby is a very simple pattern that consists of 3 bars. You can see the second bar compared to the first bar. We have the first bar, the second bar gap down. That's bearish. But the third bar gapped up from bar 2. So bar 2 gapped down from bar 1, and then the third bar gapped up from bar 2. So essentially it's just a gap down followed by a gap up. When you have a gap down followed by a gap up, it's just a quick change in sentiment. But I didn't take the trade just because of that. I took it because we had the gap down, gap up, and we had a rejection back above that long-term trend line. So I entered here 186.20. I placed my emergency stop 2 ATRs below. My end of bar stop was simply a close below this trend line. That was it. I placed my 1.5 ATR trailing stop level above. Next day, took off, profit targets. Great. Next day, big move up, took multiple profit targets into that strength, also got to trailing stop level. Next day, up a little bit, not enough for a profit target. Next day, up again, profit target. Next day, up again, another profit target. And then here on the 6th, we had our first close below a previous bar's low after reaching trailing stop level. What do? I took off half of the position for a gain of 5.68%. Next day didn't do much. Next day went up a little bit, but I had to exit here. Why? Because the next day was earnings. So I never hold through earnings. So I exited the balance of the trade. I exited 100%, the second half, the remaining shares for a gain of 6.53% because I never hold through earnings. Next day, earnings way down. I was like, whoa, man, I dodged a bullet on that. And then what? So obviously this is one of those trades where it would have been good to hold through earnings, but I never suggest holding through earnings. You can have great earnings and it can go down. You can have bad earnings, it can go up. It's just a gamble, really. And your job as a trader is to protect your money, be a good steward of your money, not put yourself in a position where bad things can happen. And holding through earnings is the worst possible thing. Yes, you can make a lot of money quickly, but you can lose a lot of money quickly. So I never suggest holding through earnings. So all in all, it was a nice, good trade. Half plus 5.68%, the other half up 6.53%, but I'm out of TMUS now, T-Mobile. Apple, okay. Just like the trade that I took on Nike, higher low V2, it's exactly the trade that I took on Apple. Remember the rules. We have the value zone. We need to close below the value zone. We need to close in the value zone. We need to have a pullback and then have a higher low V1 or V2. On Nike, it was a V2 because it consisted of 3 bars. On Apple, it was a V1. A V1 consists of 2 bars. Bar 1, bar 2, bar 2 goes below bar 1's low, but then closes above bar 1's close. That's exactly a V1, and it's very similar to the Nike trade. It's just the Nike trade was a V2, Apple was a V1. So higher low V1, I got in at 259.20. Of course, I position size, placed my emergency stop 2 ATRs below. My end bar stop, if you remember, on a V1 or a V2, it's a close below halfway of the washout bar. So my stop there is 256.60. Bar 2, the low, the high, halfway is right here. Place my trailing stop level above. Next day, takes off like a rocket ship in my direction, hit multiple profit targets, thankfully, and also got to trailing stop level in one day, which is nice. Next day, really nothing. The next day, oh, sorry, that's there. The next day, we went above the 70 during the day and then closed back below it at the end of the day. Well, that is a signal for me to exit half of my position. And so that's what I did here on the 4th, and I exited half of my remaining shares for a gain of 6.08 because it went above the 70 during the day and then closed below it. So I locked in a gain of 6.08%. And then here on the 29th, we had our first close below a previous bar's low after rejecting the 70 RSI. That is my signal, and that is my rule to get out of the remaining shares and to exit the trade, and that's what I did for a gain of 5.65%. So the first half I got rid at 6.08. The second half got rid of for a gain of 5.65. And clearly, I'm glad I got out of that trade. My signals were right, and we just fell off a cliff the last 2 days in Apple. So when we go to take a look at the trades for next week, I have other potential buy signals again on Apple in the future if it goes lower. So we'll watch those. But you can see higher low V1 in the value zone. And again, the higher low is because this low is higher than the previous low. That's a bullish setup, and you can see it did work and really nice trade. But we'll revisit Apple at the end of the podcast for some other levels to potentially get back in. Coca-Cola. Okay, really nice trade on Coca-Cola. So again, as far as the order blocks go, multiple ways to get into order blocks. Rejections at the bottom of the order block, rejections at the top of the order block, rejections of key levels in the order block. Coca-Cola, so we have an order block from the past. We go back and find it. Okay, here it is. Why is this the order block? Because we had a swing low, we had a swing high, we had a lower swing low, and then here we changed market structure to the upside, and then from there it did take off. And again, the basics of order blocks, the way that I look at it is when the market was up here, you know where the order block was down here, and you can look and go, okay, was smart money, based upon these highs, was smart money buying here? Yeah, clearly it was. So at this point, it was smart money for sure. I think undisputable. So let's bring that smart money area into the future. And if it gets back to that smart money, maybe it will be smart money again. Okay, so I entered here on the 7th of January at 67.53. Why? On this particular day, during the day, we went under the 30 RSI during the day, but yet we closed above it at the end of the day. That's an intraday rejection of the 30 RSI. That's a deep dip buy signal, but that deep dip buy signal also came in the bullish order block. Key level within a key level, and those are my favorite trades. So I entered 67.51. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI. It barely closed above it, so my risk to reward ratio is very, very good. I placed my one. It's kind of hard to get perspective on this chart because it went up so much. I put my 1.5 ATR trailing stop level above. Next day, takes off like a rocket ship. Sold into that strength. Now I'm in trailing stop mode. Next day, up again. Hit additional profit targets into that. Next day, kind of nothing. Next day, up, profit target. And then here on the 15th, we have our first close below a previous bar's low after reaching trailing stop level. What do? Took off half my position based upon the first close below a previous bar low after being trailing stop level. I took out my half of the position for a gain of 4.14%. Next day we didn't do much. Next day up, profit target, kind of moved sideways for a couple days, not much. Up again. Sorry, the ratio on this is very difficult. And then we just continued up and up and up and up and up. As it continued to go up, I continued to take profits. I exited the trade here on the 9th of February at 77.90. Why? Because the previous bar, we closed above 70. The next day that I exited, we closed under 70, and we also had a close below a previous bar's low. Those two rules happened on the very same day. And so I exited the trade, the remaining portion of that trade for a gain of 13.34%. So just really good example, everyone. You never know what's going to happen. All you can do is set up and structure your trade where you have a good risk, where you have key levels within key levels with good risk to reward ratios, just meaning that if you're wrong, you can be wrong small, but have the potential for a big upsize gain. And this is exactly what happened on Coke. So the remaining shares out of Coke now, but did lock in a gain on the remaining for 13.34%. So some really good trades. I exited a lot of trades last week. Exited Coke, Apple, T-Mobile, Berkshire, and Netflix. Now, what I just showed you were the open trades on the daily, the closed trades on the daily. I also take weekly trades. Weekly trades, the bars close on Friday. So I'm looking for the same setups, but instead of on the daily charts, I'm looking for the weekly charts. So let's start with IGV on the weekly charts. Again, each bar here is a weekly time frame. So I entered IGV back here on the 6th of February at 82.46. Why? Well, you have the green box. That means that was an order block from the past. And again, I like key levels within key levels. On the week that I took it, not last week, but the previous week, we rejected the 200-week moving average. We also rejected the bottom of the order block. So I got in at 82.46. So I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this 200-week moving average, the black line. This week, it tested it during the week, but yet closed back above, kept me in the trade. I'm essentially completely break even on this trade. Well, that's not true. Up a little bit, up 0.28%, right? But I have not got to trailing stop level, and I have not closed below my stop. So what's it going to do? I have no idea. Either does anyone else. But I know exactly what I'm going to do. If it closes below that 200-week moving average, even by a penny, I'm just simply out of the trade. If it goes back over the next week, I can get in again, right? But if it closes below and then continues down, I'm really glad that I followed my rules. So essentially up 0.28% here. Next week, close below 200-week moving average. I'm out. If it starts to move up, fantastic. I'll sell into that strength. If it gets to trailing stop mode, great. Then I'll go into trailing stop mode. But who knows what's going to happen? But you got to have your rules, and I have my rules. So up 0.28%. Last but not least, another weekly trade that I took is the US dollar, UUP. And this particular trade's very, very similar to the one that I just showed you on IGV. Same thing. It's a weekly trade that incorporates an order block and the 200-week moving average. So I entered here back on 7/11. I've been in this trade forever at 26.31. What were the confluences? Two. Previous week, we closed under the 200. The week that I bought it, it closed over. That's a deep dip buy. Close under, close over the 200. Valid, legitimate primary signal. In addition to that, we came into the order block, closed back above it. That's a rejection of the high of the order block. So those are the two confluences. That's why I bought. So I bought here 26.31. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-week moving average. Place my 1.5 ATR trailing stop level above. Next bar takes off. Great. Hit a profit target. Next day, pulled back. Or next week, pulled back. Next week, big monster up move. Fantastic. Took profit targets, multiple profit targets that week. Also got to trailing stop mode. Next week, nothing. The next week, we hit a first close below a previous bar's low. After reaching trailing stop level, what do I need to do? I need to take off half my position. And I did that for a gain of 0.49%. Not a big move, but still a gain. Then we moved sideways for about a month. This week, during the week, I thought, oh, I'm going to definitely have to get out of this trade because it was way under the 200. But yet at the end of the week, it was strong enough to close back above. It kept me in the trade, which I'm glad because the next week went up again, took profit targets into that strength. Next week, not much. Next week, up again nicely, sold into the strength. Next week, down. Next week, really nothing. Next week, up, took profits into that move. Then down a couple weeks. Next week, took profits into that move. Then we moved down for a month, and then we had a couple weeks up here where I did hit one profit. Now remember, my end of bar stop is simply closed below this 200. You can see a couple weeks ago we were well below the 200, but it closed above, kept me in it again. Next week up, profit target. So right now, everything is about this 200-week moving average, this black line. Next week, if we close below the 200, I'll just be out of the trade and we'll be done with the trade. If it continues up, I'll continue to take profits into that. If we get up to the 65 RSI level, then the 5 EMA will come into play. If we reject the 70 RSI, then I'll take some action there as well. But the remaining shares that I have on UUP up 1.9%. So there you go, everybody. I'm glad that I exited 5 positions because it was a lot to manage, and looking for some new blood, right? Looking for some new positions. So cleared out the old positions, looking for some new positions. So over the past couple months, I've had so many positions. I mean, not complaining. I've done very, very well. But just a lot to manage. So really glad that I sold these 5. So at the moment, I have 4 daily open positions. I have 2 weekly open positions, a lot more manageable. So before we get on to the trades that I'm looking at for next week, let's talk a little bit about trader psychology. Let's spend a few minutes on that before, and hopefully this is going to be helpful for you. All right, this week's trading psychology post from Uzair Hussein in the New Traders, Rich Traders group on Facebook. Cool group. You should just check that out. And this is from Adam Grimes, trader. And really this makes a lot of sense because we all hate losses, obviously, right? We hate them, but really they're necessary in trading. In any business, you have income and you have expenses. You know, there's not going to be any business that you have that doesn't have expenses. Well, it's the same with trading. Trading is a business, and your expenses in trading are losses. Okay, they're inevitable. They're just part of the game. So let's see what Adam Grimes has to say. As a trader, your losses are your cost of doing business, and you cannot have profits without those losses. You must learn to think over the next 20 trades, not the next single trade. You must avoid attaching too much importance to any outcome. If you truly understand loss, you can accept that loss, make it a part of who you are, and use it for your success. Look, I teach students all over the world, and the common denominator is, oh man, I have a loss. They take it personally. Don't take it personally. It happens to every single trader. Every single trader has losses. They're inevitable. They're like Adam says, they are just the cost of doing business. But don't look at any one loss as you're a bad trader. It just didn't work out, right? You must learn to think over the next 20 trades. I would say the next 100 trades. You know, many times if I have a really good setup, like the Berkshire Hathaway trade that I showed you, it had 5 signals. Now, that could have turned into a loss, but does it mean that I wouldn't take that trade again if I had that setup? All that means is usually, I mean, the majority of the trades I have about a 70% success rate. So that just means out of 100 trades, I'm going to make money 70 times, and I'm going to lose 30 times. And so if I have a losing trade, I'm like, oh, that's fine. That's just the inevitable 30% that I'm going to take. So don't, and I guess what I'm saying here is that, and what I've noticed with traders is that if you have a loss on IBM, for example, and then they get in the trade, they get out of the trade, and then you have another setup on IBM. They're like, yeah, I don't want to take this trade because I lost money last time. It's something different because it's the same stock. Doesn't matter. It just means that out of 100 times I take that trade, I just know that if I have a good setup, I'm probably going to make money 70% of the time and lose 30% of the time. Well, that's profitable. If I can make money 70% and lose 30, it's fine. So don't let past trading losses dissuade you. If you have a legitimate signal again, take it, right? Just I would take the trade again if it's legit because the odds are in your favor, and that's really all we can ask for. So I'm going to read it one more time. As a trader, your losses are your cost of doing business, and you cannot have profits without those losses. You must learn to think over the next 20 trades, not the next single trade. You must avoid attaching too much importance to any outcome. If you truly understand loss, you can accept that loss, make it a part of who you are, and use it for your success. So if you have a good trading setup with good back-tested results and you have a loss, blow it off. Take the trade again if it's a legitimate back-tested signal. So anyway, I hope this was helpful for you, everybody. And I always like teaching trading psychology. It's always helpful for me, and I hope this was helpful for you as well. All right, so let's take a look at the potential trades for next week. I have 12 potential trades on the daily charts for next week. And oh, I always forget to ask. Hey, listen, if you found anything in this podcast helpful so far, if you found it valuable, I really would appreciate it if you could hit the thumbs up button. It really does help the channel out, lets YouTube know that there's some valuable content here. So if you found something helpful, really would appreciate if you just take a moment and hit the thumbs up button, or subscribe if you're not subscribed. So I say this each week, but listen, here I have 12 signals, or 12 symbols, potentials for next week. Now, it is theoretically possible that next week all 12 of these could trigger, even on the same day. So does that mean that I would take all 12 signals? No, I only take one signal per day. I don't care if I have 100 legitimate signals. I'm going to narrow those hundreds down to the best one. And how do I do that? Well, I give each setup a potential quality score. Just the basics. If I have one signal and then on one stock, and then the next stock I have two signals, well, the one with two signals has a higher quality score than one signal, right? Just to make it extreme to the easy part, right? Just to simplify it down to that. But I look at how many signals there are, what's the risk to reward ratio, because you could have something that have five signals, but it can have a horrible risk to reward ratio. So you kind of have to back that out of the scoring process, right? I also like to look at multiple time frames. If I'm trading on the daily, I want to look to the weekly. Maybe the weekly is going to give me some added information. Maybe I'm going to see a rejection of a key level, not just on the daily, but on the weekly. So I take that into consideration. I also take into consideration the relative strength of the market, which means that, maybe I have five signals that trigger when the market's down, but one of those markets was actually up while the other ones were down. Well, that gets extra bonus points for that. So all sorts of different things: MACD divergences, relative strength, risk to reward ratio, higher time frames, multiple signals. And so the devil's in the details when it comes to trading, and I think this is a real skill to have in order to narrow down the best trade. And this is how I trade, and this is how I teach my students. And just so you know, I do teach students all over the world. I teach a 20-hour trading course. Each session is 2 hours, and then we have 10 sessions, and it's one-on-one. It's just you and I. And in that course, I teach my students every single thing I know about trading. I teach them all the strategies that I use, all the rules that I use. And I think the best way to learn anything is one-on-one and consistently. That's why I like to do it over 10 weeks, because we go through a lot of different market conditions together every week, right? We can look for potential trades. I look at your trades, give feedback on your trades. So if you're interested, I would love to have you as a student. I'll teach you everything that I know, and all you have to do is email me. My email is in the link of this YouTube video. And I might add, one of the important things in the course that I think is very important is not only do I teach you, but we do a lot of simulation trades where I'll teach you the signal, and then later in that lesson or later in the course, you have to teach it back to me. We look at random time frames, we look at random setups, and you're telling me what to do. I'm not telling you what to do. And I just sit back and go, yeah, that's right, that's right. No, it's not right because of this or that. So I know you're going to be a better trader if you take this course. And like I said, I'll teach you everything I know. I'd love to have you a student, so just send me an email and we can get the conversation started. If you like online courses, I have a really great online course available at udemy.com. The link is in the description of this video. It's the Deep Dip By course. It's a great course. It's 9.5 hours. It's very affordable. It's between $30 and $50 on Udemy. And I teach you step by step the Deep Dip By approach. So if you like online courses, that's a great option too. I mean, obviously the one-on-one is better and more complete because I teach you everything, but the Deep Dip By, that's a good place to get started as well. So, okay, that is the end of my plugs for today. So let's get on to the potential trades. So, all right, so I took Apple, I took Apple with this higher low V1 in the value zone and rejection at the top of the order block, I might add, and got out based upon my rules, and it was the right place to get out. But look, in the green here, we have a very wide order block, a very tall order block, way up here, way down here. So I'm looking to buy something in the order block, but it's way too wide just to take with the rejection of the high of the order block. So I have to look for key levels within key levels. Well, the order block's the key level, but I'm having to look at different levels. So the first thing that comes to mind is that, look, we're at a 39.59 RSI, okay? From a deep dip buy perspective, a deep dip buy is an under 30, over 30. So that would be legitimate. We're a ways from that, 39.59. But if Apple continues to move down, eventually we're going to get to the 30 RSI. And if we reject the 30 RSI intraday inside this order block, that would be a legitimate key level for sure. So next week, a rejection of the 30 RSI level, totally legit. If it does, I would consider taking the trade. Alternatively, and you heard me talk about this earlier in the podcast, look, we have a V2 here. Remember V2s? Bar 1, bar 2, bar 3. 2 has to go under bar 1's low. 3 has to close over bar 1's close. If we have a V1 or a V2, where is the inherent support? Halfway of the washout bar. That's why I drew this green line here. Halfway of the washout bar of the V2. So, two potential options on Apple. If we continue down or reject the 30 RSI, that would be one potential entry. Then my stop would be a close below the 30 RSI. Alternatively, if we head back down even further and reject this 246.40 level, the halfway of the V2 that I drew in here, the green bar, that would also be a level. And then, of course, a rejection at the bottom of the order block, that's kind of has to go unsaid. Can go unsaid because a rejection at the bottom of the order block is always legitimate as well. So going forward next week on Apple, a rejection of the 30 RSI is one potential, a rejection of the halfway of the V2 bar, or halfway of the V2 of 46.40 of the washout bar is a key level, or rejection of the bottom of the order block. So those are the levels that I'm looking at for Apple. AMD. Very similar. We have an order block from the past. By the way, I took this trade on AMD here. Why? Rejection of the 100-day moving average and a rejection of the top of the order block. Look at that trade. That was a fantastic trade. I got out at the right time, obviously. But now we've come all the way back down here, and I'm looking at some key levels in the order block again. And the key level, there's two key levels in this order block, and this is a pretty tall order block, by the way. But I have two levels here. I have the $210 level. I have the $196.80 level. So let's see why I picked them. The first level, the 210, comes back to this big up bar here on the 25th, right? If we have a big up bar, halfway is going to be some support. That's the 210 level that I brought in here. We could certainly test that level next week. And if we do and reject it, I would consider taking the trade. And that would be my stop. My end of bar stop would be the if we need to reject the 210, but if we then close back below it, that would be the stop. Additionally, again, another level here is the 196.8 level. Why? Here's your V2. Bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Where's the support? Halfway of the bar 2, the washout, 196.80. So again, two important levels inside the order block. If I reject the 210, $200.10, that's one potential entry. The second is the 196.80. The third, of course, would be the low of the order block there, a rejection of 193.96. Google. Wow. Everybody wants Google. Nobody wants Google. That's how it goes. Okay. So we have an order block way back here. The order block was formed on 217.25. Why? Swing low, swing high, lower swing low, market structure change. Again, when the stock was up here and you look back here, was this smart money? Yeah, clearly it was. So this is the smart money area. We are back in the smart money area. Okay, we're in the order block. Does that mean just buy? No, I need to reject something. We could have a rejection of the high, the order block. That would be legit, but where are you going to have your stop? All the way down here? It's not a good risk to reward ratio. So I'm looking for the following levels. Right now we're at 32.27 and under 30, over 30, that could happen next week easily. That would be a key level. Okay. If it rejected the 30 RSI, I would consider that taking that trade. My end of bar stop would just be a close below the 30 RSI if I take it because it rejected 30 RSI to the upside. Alternatively, the bottom of the order block here, about 296.02, it's the bottom of the order block. That's always a legitimate entry, but you see how we have the 100-day moving average just trying to kiss the bottom of that order block. So right about in here is also a legitimate potential for a rejection. So a rejection of that 100, I would consider taking that, the red line. And if that happened, you're very likely going to reject the bottom of the order block as well. So two confluences there. Or again, like I said, we're at 32.27 RSI, so a intraday rejection of the 30 RSI would be legit, or a close under the 30 RSI and then a close back above 30 RSI would also be legit. So Google, GOOGL certainly could trigger next week with rejection of the 30 RSI or a rejection of that 100-day moving average low of the order block at 295.72. IWM, which is a Russell 2000. Okay, so we have a little order block here. Why? Swing low, swing high, lower swing low. Market structure change defines the order block, the lowest closing bar, the high and the low moving forward. Okay, look, we have a 50-day moving average that lives inside of the order block. Okay, a rejection of that, I would consider taking it. That would be my line in the sand. I also drew the line here, 258. Why? V2s all day long. Look, here's a V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Where's the support level on that pattern? Halfway of the washout bar, 258. You can see that 258 level is very close to the 50-day moving average level. So next week on the Russell, if we reject either the 258 and or the 50-day moving average, which is the 257.58, that would be a legitimate potential entry, depending on how it closes, depending on the risk to reward ratio. So that's what I'm looking for IWM. And of course, again, a rejection of the low of the order block, the low of the order block's 255.05 would also be legitimate. Doesn't mean it's going to work. It just means that it's rejected at a key level with a good risk to reward ratio. MasterCard. Oofa. All right, well, we have an order block. We lost this order block. Where's the order block? Here, swing low, swing high, lower swing low, market structure change, defines the order block, and my MasterCard was so weak that it just closed below the order block, right? Okay, going forward, if we close back above in the order block, could I take the trade? Sure, I could. You also see this trend line here that I have that goes way back here. This is not a megaphone trend line. This is a regular trend line. This swing low connected to a higher swing low. We lost that trend line. But if we can recapture that trend line, we will also reject the bottom of the order block. So a couple different ways I could look at this. Next week, if we close back above the bottom of the order block, we close back in the order block, that would be legitimate. Then my stop would be a close below the order block. Or if we close back above the trend line, that would also be legitimate. By default, we'd reject the bottom of the order block, and then I would probably use the trend line, a close below the trend line, as my stop. But kind of the interesting thing that I want to point out here is that we have what is called the double bottom bullish divergence. Now, I studied one-on-one with Dr. Elder, and one of the pioneers of double bottom bullish divergences. And we have a major double bottom bullish divergence. So let me show you what that is. So during this leg down here, you can see the red bars are very deep. What does this mean? This means that there is a lot of, the momentum downwards is very strong by lieu of the big deep bars. It just means there's a lot of selling. Okay, so we made a low here with very deep MACD bars. Then we rally into green. We have green MACD bars. Well, now look at where we are here. We are lower here than we were here. Would you agree? Obviously, we're lower here than there. But look at the MACD. The MACD is red, but it's not as deep as these MACD bars. What is that telling us? That's telling us the selling momentum is decreasing. It's waning. It's going lower, yes, but not on the same momentum as the first move down. This indicates that you are running out of selling momentum. It indicates that you're running out of sellers. And the implication is if you're running out of sellers, you're going to go up. So whenever there is a double bottom bullish MACD divergence like there is here, I always pay attention. Now, just because you have a double bottom bullish divergence doesn't mean you just rush in and buy it. I still need an entry trigger to trigger me into the trade and give me some structure to the trade. But it's something I look at, and this jumped right off the page of me. It's like, whoa, big time MACD bullish divergence. Yes, we lost the order block, but if we can close back in it, in lieu of the double bottom bullish divergence, I'm going to be watching this carefully. So whenever I have a double bottom bullish divergence, I watch it because the implication is more times than not that it's going to be heading back up, but I still need the entry signal. And the entry signal, again, would be a close back up, back in, at the very least, a close back into the order block from below. Meta. All right. Had a great trade on Meta. Bought back here on the 21st of January. Rejection of the trend line, rejection of the high of the order block. Really nice trade. Wrote it to here before earnings. Didn't stay in through earnings. Next day I was like, wow, I wish I'd stayed through earnings. Now, not so much. Okay, but look, we're coming to some key levels here on Meta. I covered this last week, but we never got there. There's a couple interesting levels here. So the first would be this trend line. This trend line from before. It's one of the reasons that it got me into the trade here on the 21st, because the previous day we closed under, then we closed above the trend line, and we closed above the order block, right? So that was confluence, and it worked out well. Well, this trend line is continuing to move into space. So if we come back down to this trend line, which right now, I don't know, it's like 618, 619, there should be some inherent support at that trend line, and we'll see whether or not the market reacts at that level. But the interesting thing about this trend line level comes back to these two bars. These two bars are called an abandoned baby. An abandoned baby happens when you have a gap down, then you have one or more bars that go sideways, and then you have a gap up that leaves these bars kind of by themselves. It's like an abandoned baby. It's just that it consists of more than one bar. An abandoned baby is one bar, and an island reversal is two or more bars. So we have a gap down, one day sideways, gap up. That makes this a island reversal. The key thing with an island reversal, everybody, is the high of the island reversal that tends to have a lot of support. And the high of the island reversal is 618. So I know that there is some support in the future at that 618 level. And in addition to that, look where it dovetails. The high of the island reversal, 618, is very, very close to the trend line. So there is your confluence. Now, just because it gets there, it doesn't mean I buy. I need to have the market show me that there's a reaction there. You need to let the market react. You can't anticipate that it's going to react. You need to wait till it does react. So going forward on Meta, if we reject that, essentially, if we reject that 618 level, I would certainly consider entering there. And ideally, it would reject the 618 level and the trend line. So I'm going to be watching this trade very closely. My stop would be a close back under either the trend line or the 618 level, probably the 618 level just to make it easier. But that's a good possible potential setup right there. By the way, talking about abandoned babies, there's your abandoned baby. Gap up, gap down, that's bearish, was it right? Yep. Morgan Stanley. All right, well, the financials have really, really struggled. Look at that. Really struggled. So where am I looking? This one's pretty easy, everybody. Here's your order block, 200-day moving average in the order block. Why was this an order block? Swing low, swing high, lower swing low, market structure change. You can see it came back to the order block, came back to the order block, took off. But again, when you're up here at 191 and you're looking back at the levels of 155, was smart money buying here? Yeah, of course. In hindsight, 100% when you're up here, smart money was buying here. Well, I want to bring that smart money area into the future. Does it mean it's going to work this time? Is it smart money again? Not necessarily, but more times than not, it is. And I have a key level within a key level. I have the order block, which is a key level, and I have a 200-day moving average, which is a key level. Now, we're pretty far away from that. Likely it's not going to get there, but if it does, I want to be prepared and know that that would be a potential area. So next week, not highly, excuse me, not highly likely that it's going to get there, but a rejection of that 200, which at the moment is 153.38. If it does get there and rejects it in that order block, I would consider taking the trade. I would use the 200 as my stop. Microsoft, my goodness. Look at this, everybody. Oh, abandoned baby. Gap up, gap down. Was it right? Yeah, big time it was right. Okay, we are really oversold on Microsoft for sure. Now, we have a long-term trend line from way back when. Let's see if I can find it here for you. Here it is. This swing low, higher swing low, connect the two, go out into space. If we come back next week, if we continue down on Microsoft and we reject that trend line, I would certainly consider the trade. Now, would I take the trade just because of the trend line? Probably not. But look at the RSI. We're 32.39. From a deep dip buy perspective, an under 30, over 30 would be a legitimate signal. If next week we go under 30 and then close over 30, and at the same time go under the long-term trend line, reject it, and close back above it, there's the confluence. So really, that's what I'm looking for. Next week, I am looking for a rejection of the 30 RSI and a rejection of that long-term trend line. That would be a great entry, high probability trade. Doesn't mean it's going to work, but it has a high probability trade. Logically, Microsoft is way oversold. And if it did reject that 30 RSI and it did reject that trend line, then it closed back below the trend line or the 30 RSI, or both would be my stop. But I like this. I'm going to watch that very carefully. NVDA, okay, you know, this one's kind of a long ways away, but order block. Why is it an order block? Swing low, swing high, lower swing low, market structure change. People that bought down here when it was up here, smart money. We came right back to the smart money, and that's exactly where it bounced again. I was looking to buy this if it rejected the bottom of the order block, but it never quite got there. But moving forward, it's pretty simple. You have the 200-day moving average, which at the moment is 171.66 inside of that order block. So if we continue down, next week, hopefully not, but if we do and rejects that 200, I would consider it. The only thing about NVIDIA is if I do take that trade, earnings is coming up and I would have to get out before earnings regardless. So I was in the money, out of the money, or whatever. Okay. Silver. A lot of people have been asking me about silver. By the way, this is an island reversal. Gap up, multiple days sideways, gap down, leaving these all by themselves. Was it right? Yep, it was right. But we're a little oversold here. And we have a nice bullish order block here. Swing low, swing high, lower swing low, market structure change. I've been wanting and looking to buy silver, but I just haven't got the signal yet. If we come down next week and rejects the high of this order block, looks like the high is about 66.83, I would consider there. Really, I would like to buy the bottom of the order block. The bottom of the order block is 63.53. Why? Well, one, it's lower, and two, this negative third ATR channel, it's dovetailing pretty close to the bottom of that order block. So I don't think I'm going to get involved in silver too much unless I have a V1 or a V2. But I know for sure if I reject the bottom of that order block and also reject the bottom of that negative third ATR channel, I would definitely be likely to take that trade if that happens. And the low of that is 63.53. One other thing I want to point out here. I've talked a lot about big up bars and the price coming back to the halfway of the big up bar and that support, and that's true. But it also works the opposite for big down bars. I just want to give you a couple examples. Look at the big down bar we have here. Would you consider that big? Yeah, I would. If you have a big down bar and then you rally back to halfway, that's resistance. Did it work? Yes, it did. Big down bar, rallied to halfway before it headed back down again. More recent example, Thursday's big down bar. Well, Friday we rallied a little bit. Where did we stop? Halfway of the big down bar. So, this is one of the skills in trading is, yes, okay, you have your setups and so forth, but it's very important to look to the left. It's very important to look in the past to see if you have big down bars. And if you have big down bars, it makes me less likely to want to take the trade because I know if I get to the big halfway back up to the big down bar, I'm going to run into resistance. Conversely, if you have big up bars in the past and then you come back to the halfways, then I'm much more likely to buy because I know that is a support area. So just something as I was before the podcast I was going through, I was like, I want to point this out in podcast. Big down bars tend to fail halfway. Did it fail? It did. Big down bars tend to stop going up, fail to halfway. Did it? Same thing happened here. Tesla, TSLA. All right, a lot of stuff going on with Tesla here. We have an order block from the past, and we have some key levels, multiple key levels in this order block. Now, would I take a rejection of the high of the order block? Maybe. If I did, I would use a stop below that trend line as my stop. But the two levels that I like the best are this 393 level. Why? Back to V2s. Bar 1, 2, 3. 2 goes under 1's low, 3 closes above bar 1's close. Halfway of the V2 of the washout bar is the support. So I'm looking at 393. It's the support level of the V2 inside the support level of the order block. Also, of course, obviously, the 200-day moving average is down here as well. That would be a no-brainer. A rejection of the 200 inside the order block, or again, a rejection of the bottom of the order block, which looks like 383.66. So I would imagine if Tesla does get into this area that it will find some buyers, but I'm just speculating. I don't know for sure. I just from experience, I say that, but I could be totally 100% wrong, and I often am. But I know the levels that I'm looking for rejection of. And right now, okay, a rejection of the trend line possibly, depending how it looks on that day. Maybe it has a rejection of the trend line with the V1 or V2. Okay, that adds extra bonus points. But what I can say definitively at the moment is I'm looking for a rejection of 393, which is the halfway of the washout bar of the V2. If it rejects that, I would consider taking it, depending on the risk to reward ratio. My stop would be a close back below 393, or a rejection of the 200-day moving average, which currently is 385.16, or a rejection of the bottom of the order block as well. Last but not least, XLF. I told you the financials are having a very, very difficult time. Look at this. All right, this order block goes all the way back to 1120. Why? Swing low, swing high, lower swing low, market structure change. When you're way up here at 56, people bought in the order block down here 51, smart money. Sure. Look, now we've come all the way back down into the smart money area. Now, could I have taken this trade on Friday? I could have. Why? Look, here's the orange line is the 300-day moving average. The purple line is the 250. Did we reject the 300? Yeah, we did. We did it Friday. We did it Thursday. 2 days. The reason I didn't take the trade, everybody, is because this big down bar. If I'm looking to take a trade and in its very recent past it had a huge down bar, it kind of dissuades me from taking the trade, because if we do rally, where's it probably going to stop rallying at? Halfway of the big down bar, right about there. So I'm just letting this one go. All right. I'm just letting this one go. And just an example of why I don't take, not all the time, but the majority of the time, if there's a huge down bar in the recent past, I'm just not going to take it. But this is a judgment call. It was a legitimate trade on Thursday because it rejected the 300. Friday, also a legitimate trade. Had you taken it on Thursday, you'd still be into the trade. So it's tested 2 days below this 300, yet there were no more sellers. That's why it closed back above. But just the nuance of the trade of why I didn't take the trade. I like the Nike trade much better, the higher low V2 in the value zone. But one thing I do want to point out, let's look at the MACD. Here's your low here, deep red MACD bars. You rally to green? Yes, you do. Are we lower here than over here? Yes, we are. Is there less deep MACD bars here than there? Yes, there is. So there is a double bottom bullish MACD divergence forming for sure. Just from experience, what I am looking for on this particular trade, which I feel most comfortable with, would be an under 30, over 30. We are at 34.81. If we continue down and reject the 30 RSI and also reject the bottom of the order block, that would be the ideal place for me to take the entry. So just to be clear, really what I'm looking for in XLF would be a rejection of the bottom of the order block. Looks like that's about 51.08. And I would like the trade a lot better if it also had the confluence of the rejection of the 30 RSI. So there you go, everybody. That is what I'm looking at for next week. If you have any questions about this or anything else I discussed in the podcast, please feel free to put a comment in the comment section. I'll do my best to get to you. I hope you enjoy your long weekend. I hope you're having a nice Valentine's Day. I always like to leave off with, please try, if you have the opportunity, please try to go out and do something nice for another human being today. If you have the opportunity, if you do, it's going to make their day feel better. It's going to make you feel better. It's just a good thing to do. And if we were to all do something nice for someone else every day, God, the world would just be a better place. If you have the opportunity to have a little, make a nice act of kindness for an animal, that would be fantastic. They appreciate acts of kindness just like we do. So, we like it when somebody helps us or has an act of kindness towards us. Why not just pay it forward to someone else? So, listen, I hope you have a good rest of your weekend, everybody. I hope you enjoyed the podcast. I hope you found something valuable. And again, if you did, I really would appreciate if you could hit the thumbs up button. Helps me out a lot. And God willing, I will see you next week. But please be careful. Get yourself a process. Follow the process. And if there's anything I can help you with teaching, coaching, consulting. I do a lot of that in a lot of different ways. So if I can help you with anything, just reach out to me and be nice to talk to you. All right, everybody. Thanks a lot. And on the way out here, I have to run the U.S. legal disclaimer. Take care. Bye-bye.
Government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.